In 2007, we launched Questmark 3. That was a $300 million fund. In retrospect, it was too large. We actually turned away capital, and we invested that fund in 18 portfolio companies. We've had some pretty good liquidity there. We have some companies that remain in that portfolio, 8 that are on a track to get liquid. I think we'll see a couple of those events happen this year, and that will determine the outcome of that fund. In 2013, we went out to launch. We realized that $300 million was too much capital. We went out to launch a $200 million fund, and we closed on $152 million, and that was a disappointment. We had some commitments that never closed, and we decided to stop fundraising. We're not good at fundraising. It was a difficult environment, and that will probably prove to be our best fund. We've made 9 investments in that fund, all on a good track, and we'll probably make 2 or 3 more investments before we launch the next fund. If you look at the venture environment, you could really break it down, I guess simplistically, into early stage or late or expansion stage companies. And what the early stage guys do is they'll make a whole lot of bets on many companies in the portfolio, and most of these companies will be pre-revenues. They'll be the Series A or a seed round, and they hope that the technology works out, and they're going to get some terrific winners. So we know those winners. You can look at Google or Facebook and so forth. But when they invest, they probably will make money on 25% of their portfolio companies, and they'll probably lose money on many of the ones in there. What we do in the late stage areas, we try to find companies, as I've said, that have proven products, management teams in place, and commercial revenues. And the hope is that we won't lose money on any of these companies, that they won't disappear or go bankrupt. That doesn't always happen. But our returns have been more or less in the 2 to 6x compared to a venture earlier stage fund that might get 100x on a company. Our space goes in and out of being competitive. We've gone through periods where the mutual funds, the hedge funds, and other people come into this space and pay high prices for companies. Lots of times the mutual funds will do it because they want to get into a potential IPO company before it goes public. That didn't work out in 2014 and 15, and fortunately for us, they're not as active in our space. So we're seeing valuations come down, and we're able to get into some really terrific companies with the traditional venture capital investors in there, people that know how to build companies and guide them. So when you look at our deal pipeline, as I've said, many of these come from the early stage venture investors who need a later stage partner. And we tend to lead rounds. We like to lead, we like to price, we like to lead the due diligence. We'll take board seats or observer seats. And one of the things that helps us get into deals is we're very aggressive with customer introductions, and the companies like that. And we'll circulate a list of every company that we've invested in and the CEO's name and contact, and use that as a reference that helps us get into deals. We also go out to conferences, we read a lot, we hear about companies from fellow board members. So this all comes into a funnel where we'll look at hundreds of deals to make a handful of investments. And when I say hundreds, these are hundreds of deals that qualify because they do have commercial revenues. They're in an area of a space that interests us. And then we dig and dig and dig, and we have usually months to do our due diligence and to figure out whether we think we're making the right investment or not. Our most recent fund that we're investing now, we've probably looked at well over 400, maybe close to 500 companies that would qualify. We whittle those down. Sometimes when you're doing your due diligence, they prove to be a little earlier or less proven than you want. And then valuation comes into play. We tend to be very cautious on valuations. And out of those 400 to 500 companies that we looked at, we might put in term sheets. I think in Fund 4, we put in term sheets for 11 companies, and 2 we lost. We invested in 9. And I think that's proven to be a very good portfolio of 9 companies. One has already gone public. It's trading at double the price that we invested in. And then we just exited ServiceMax, which was acquired by GE, for a nice return as well.